Amazing. So it is 10 o'clock. So we'll just get started. For those who maybe can't make the whole AMA, this is going to be recorded. It's going to be posted on the YouTube as well. First of all, I want to thank Robert and Jacob for coming over and hosting this, or coming over for an AMA. For those that don't know, this is Clearpool. Do you guys want to get started with some introductions?
Sure. Can you hear me?
Yeah, we can hear you.
Okay, great. Yeah, hi guys. Thanks for having us today. I'm Rob. I'm co-founder and CEO of Clearpool. My background is in traditional finance originally. I spent many years as a broker and as a banker. I worked in fixed income, mainly capital markets. Ended my career as a repo trader. I worked in the UK, London, in the US, in the Middle East, and in Asia, in Hong Kong, Singapore. I got into crypto in 2015. Was working on some side projects during 2016-17 bull run. Stayed in throughout all of that time. Worked on a number of things and invested in a lot of projects and traded crypto for a long time, and then eventually decided to get into this space full time, and came up with the idea for Clearpool with a friend and ex-colleague of mine, Alessio, who's the third co-founder, who's not on this call. And yeah, that's it. Left the bank about just over a year ago and founded Clearpool. And yeah, that brings me up to today. I'll pass over to Jacob for an intro.
Yeah, thanks, Rob. So we are three co-founders. As Rob mentioned, Alessio is not in the call. So, out of the three co-founders, I'm the one who doesn't have a TradFi background, but I have a startup background. So I used to, build and scale large marketplace businesses. One of those was like a large food delivery company, and the other one was a e-commerce company. Both those companies listed successfully. So it was really like from zero to IPO, and we've built it up across a couple of different countries. And then I went into fintech. I was with an alternative lending company out of Southeast Asia, out of Singapore. And we basically provided lending solutions for everyone that was left out by traditional finance. It's a little bit like crypto. The counterparties were different. It was more like small SMEs, mom and pop shops, e-commerce, online marketplace sellers. And around that time as well, I started looking more and more into crypto around 2016, 17, at the beginning, just privately. But then when DeFi came out, especially lending, DeFi summer, and the rise of protocols like Aave and Compound, I got more and more excited for DeFi. And I met Alessio and Rob. They had this idea, and we realized that we had a pretty good complementary skill set, and that's when I joined them to build Clearpool.
Amazing. That's awesome. So for, say, a non-technical person, how would you guys describe Clearpool in simple terms?
Yeah, good question. So Clearpool is, for a non-technical person, it's just a place where you can lend stable coins to high-quality borrowers and receive a yield for doing so. So on Clearpool, the loans are uncollateralized or unsecured. So that means that you are lending to the borrower, and the borrower is basically relying purely on their credit reputation. They're not providing any collateral. So when you compare it to something like Aave or Compound, which I'm sure you guys are familiar with, when you connect to Aave, you see a marketplace for assets like USDC, USDT, and so on. And when you connect to Clearpool, you see a marketplace for borrowers. As I mentioned, when you lend on Aave, it's fully collateralized or over collateralized. In fact, that means that you don't need to know who the borrower is, and it's relatively safe in the event that the borrower gets into trouble. But on Clearpool, it's kind of the opposite. There is no collateral, as I mentioned, but you do know who the borrower is. and therefore, as I mentioned, the borrower can borrow based on their credit reputation. And of course, the yields are much higher because of that. So right now on Aave, the yields are very low. I guess still less than 1%. I haven't checked today, but on Clearpool, most of the borrower pools are around about 10% or even higher. So the difference in yield is quite significant, and of course that is there to compensate you for lending, for taking on the risk of lending unsecured. And then, slightly more technical, I guess, the pools, they're all single borrower pools. So you decide exactly which borrower you want to lend to. But the pools are dynamic in that the interest rate that you receive is based on the amount of liquidity that the borrower is utilizing or borrowing from the pool at any point in time. So to use an example, if there's $10 million in the pool and the borrower removes $8 million, they're at 80% utilization, and there is a corresponding interest rate at 80%, which at the moment would probably be around about 9.5%. And this is the rate that the borrower has to pay to all of the lenders in that pool. If the borrower decided to increase the utilization, let's say they wanted to go up to 90%, or let's say that some of the LPs removed liquidity and that increased the utilization up to 90%, then the interest rate also increases. So the lenders are being compensated for that liquidity risk. So when there's less liquidity in the pool available for withdrawals, you're being compensated with higher rates. But in normal times, as you will see, if you look at the interest rate curve in any of the pools on the app, you'll see that the borrowers are incentivized to be around about 85% utilization. This is where the lowest rate can be found on the curve. And that means that in that scenario, there would be 15% of the liquidity remaining in the pool for withdrawals. So theoretically, you can remove your liquidity at any time you want. And yeah, if that utilization does go up and the amount of liquidity available for withdrawals goes down, then you get compensated with higher rates. So it's very flexible from a lending perspective, given that you can select who you want to lend to, and you can remove your liquidity at any time. But it's also very flexible for the borrowers as well. Borrowers can draw down liquidity whenever they want. They can repay liquidity whenever they want, and the interest accrues to their utilization. But all else equal, utilization would tick up very slightly on every block, and at some point they may decide to repay some liquidity into the pool to maintain utilization. So yeah, it's very flexible for lenders and borrowers. Hopefully that answers the question.
That does, and it actually answers the first community question we had in terms of the percentage interest rate or annual percentage rate that was shown, because 12% is really high, compared to other protocols that were out there. One of the other questions we had that was asked from the community is, how is an uncollateralized loan safe for a lender? What happens if an institution borrows millions and just doesn't pay it back? Besides a bit of their credit.
I'll let Jacob answer that. Maybe also Jacob can touch a little bit more on how the APR is calculated, because there's the CPOOL component to that as well. I'll hand over to Jacob.
Yeah. So I think the first question, just to be clear, and I think that's one thing that should be straightforward, but it's not always straightforward in crypto and in DeFi. The rate that you're seeing right now, which is roughly 10%, is nearly exclusively made out of real yield that is actually paid by the borrower. So currently, if a pool pays 10%, then approximately 8% of that is actually coming from the interest rates that borrowers are paying. And currently, roughly 2% is made out of CPOOL incentives. And then we have those pools with the Polygon pool. So we recently launched on Polygon, previously just on Ethereum, and those Polygons currently pay an extra 2 or 3% on top of it. But I'm just stressing this because I feel when it comes to yield, very often it's not always it's not always easy to compare, because I'm stressing here that this is real yield. most of it is actually yield paid by the borrower. It's not just a yield that is made up of, I would say wasteful and sometimes silly token incentives that I think only really work in a bull market. So, we are approached these days a lot, and people say, Clearpool really fits into this real yield narrative. And I think that's actually quite funny, because yield should always be real, at least to some extent. But we just realized that a lot of protocols in DeFi have a completely artificial yield that is purely based on some tokenomics. But this yield is really coming from actual interest that is being paid. So yeah, that's just to add on the first question. Then I think on the second question, which is what happens in the case of a default. I think also here, it's really important to be very transparent. And by being transparent, I mean that I have to say that there's also a reason why those yields are currently 10% versus versus very very little below 1% that you're getting on Aave and Compound these days, because those protocols are over collateralized, which means that they're very very safe, right? In the event of a market downturn, the position of the borrowers are basically liquidated, and the lenders are getting back their money. So it's very very safe. It mainly just faces protocol risk, or maybe a risk that can't be liquidated fast enough. But in this particular case, we're really talking about unsecured loans. Now, when it comes to unsecured loans, in the case of a default, there would be losses from lenders, and this is why I'm saying that there is risk involved, and this is why we're paying higher risk-adjusted returns. When it comes to what happens in the event of a default, we have some mechanisms built in. So every pool has an insurance pool, where a percentage of the interest paid by the borrower accrues and will be made available to LPs in the event of a default. The borrowers, when they sign up to Clearpool, so when they're getting onboarded, they also need to sign a suite of legal documents that include a lending agreement, and that states that there will be a legal recourse in the event of a default. And actually, when a borrower really goes into default, so when a borrower cannot repay, the default scenario is triggered if a pool hits 100% utilization, and the borrower cannot pay down to below 95% within 5 calendar days. If that happens, then a auction will be triggered, and that auction allows participants, those are whitelisted participants, to bid for the pool's debt, basically. So whitelisted participants would bid on the LP tokens, liquidity provider tokens that they get when they provide liquidity, like they received. We call them CP tokens at Clearpool, and the highest bidder would basically win that auction, and would win that claim. So you could imagine that for example, it could be like 20 cents on the dollar. So there is $10 million US, and someone pays $2 million US. And then there would be a vote, and the lenders can vote whether they want to accept this highest bid. If they accept that highest bid, they can redeem their CP token, and they would get a pro rata allocation of this $2 million. So in this particular case, they would still get 20%, but there would be a loss of 80%. I think, really, again, it is important to understand the risk here. It's unsecured lending, and there can always be, losses in case of a default. Maybe just to add here, our rating process is very rigorous. So we're working together with our partner. This is external, but it's a very close partner. They're called X-Margin, and they're at the forefront for when it comes to rating and risk assessment in the unsecured lending space. And besides looking at static information such as financials and due diligence, which is basically what currently all the centralized players, but also all our I would say decentralized, other decentralized players are doing. They're also looking at real-time data. So as a borrower, I would need to connect the trading accounts that I'm having, and also the DeFi wallets that they're using. And then we're basically able to see in real time what's the equity across all those different exchanges and DeFi strategies. and what sort of delta they're trading on. So what sort of like risk they're trading on. Also, we're vetting very carefully all those lenders. They're mainly market makers that are executing market risk neutral strategies. So market risk neutral strategies means that those are like arbitrage strategies where they have a lot of different trades that are taking advantages of small price inefficiencies across different venues without really going into any directional exposure. So they don't bet whether the market goes up or down, but they're just making money on volatility. So we believe those are relatively good borrower profiles in terms of risk.
Perfect. So we kind of explained over, the interest rates, the uncollateralized loans. So in the past months, we've seen that many centralized lenders have halted withdrawals or went insolvent. How can a decentralized platform like Clearpool avoid this?
Yeah, so when you were depositing to those centralized lenders like Celsius, for example, they were offering or promising, let's say a yield of whatever it was, 6%, 8%, which is fine, but you had no idea at the time, what they were doing with your hard-earned crypto. I mean, now you do. You know they were lending to to highly risky hedge funds, which are kind of the opposite to the type of borrowers that Jacob was just talking about, because they are kind of few and far between. So these guys, in order to be able to continue paying the yields that they promised to their depositors, they had to start taking riskier bets, and that meant that they were lending to the 3ACs and similar. And of course, we saw what happened, right? So we don't really need to go through all of that. But ultimately, what this meant was that those guys had to halt withdrawals, and people lost money. Quite simply, on Clearpool, we cannot halt withdrawals. It's a decentralized protocol, and I explained earlier how it works. So you can withdraw whenever you want, providing liquidity is available in the pool. So the difference really is that on Celsius or the centralized lenders, you have basically a centralized intermediary between you, the depositor or the lender, and the end borrower. So on Clearpool, that's completely removed. It's just you and the borrower and a smart contract in the middle. So when you lend on Clearpool, you're making the decision who you lend to. So you can select Wintermute or Amber or one of the other borrowers. If there's a borrower on there that you're unsure of, you don't have to lend to them. And this is really important because it gives you control of your funds, not just in terms of making that decision on who you want to lend to, but also having the ability to withdraw the funds whenever you want. If you think that market is turning, there's going to be more risk. You might decide to reduce your exposure, which you can do either to one or all of the borrowers. You can remove all of your liquidity, and these decisions will be yours. So it's very different from centralized players, and as I mentioned, there's really absolutely no way that Clearpool could halt withdrawals. It's purely based on the dynamic structure, which I explained earlier.
Awesome. So you guys recently partnered with Polygon and Layer 0. What benefits is this going to bring to the Clearpool ecosystem?
Yeah, so Polygon is an integration that we had planned very early on. So we had first call with Polygon over a year ago. Really before we'd even sort of written much code. And that's a conversation that has been ongoing the entire time. So it's kind of in a very early roadmap to launch on Polygon, and I think the benefits they're already clear. We knew that launching on Ethereum would make the protocol expensive for certain types of lenders, and and we wanted to address that as early as possible. So that was the idea behind launching on Polygon. So already we see on Polygon, obviously much lower gas fees and higher transaction speeds. What that led to is within, I think, the first 10 days of the launch on Polygon, we had more than double the amount of unique LPs in the Polygon pools as compared to the Ethereum pools within the first 10 days. And that's even more now. I don't know the exact number, but I think it may be even close to sort of triple the amount of LPs. And during that time as well, the total liquidity provided on the protocol has gone up as well, from, I don't know, 90 something to today, maybe 106, 107 million, something like that. So we've seen an increase in the number of LPs, an increase in the liquidity provided, with only one new pool launched as well. So this is very clear that that strategy of launching on Polygon is working. So we're very happy with that, and that's going to help us scale even further as we start to introduce new borrower pools to the protocol soon. Layer 0 came kind of on the back of that. We obviously needed to bridge C-pool between Ethereum and Polygon. We selected to Layer 0 for this bridge. Layer 0, I think, is one of the leading omnichain interoperability protocols out there. We have common investors in SOLANA Global and maybe a couple of others. So we got introduced to the team. They're very impressed with them, and they were very keen to work with us as well. So it was a very easy decision to make. So the first phase of that is the bridge, which is already available. And the second phase, we're working on being able to use the messaging layer to attract liquidity from multiple chains. So if you have USDC on, let's say, Avalanche or BSC, or one of the other chains that's supported by Layer 0, you'll be able to interact directly with the UI on Clearpool and lend that USDC, just as if your funds were already on Ethereum or already on Polygon. So you don't have to bridge those funds first. So basically what it means is we can attract liquidity from all of those other chains without having to actually exist on that chain. So this is huge because, first of all, it means that we don't need to build and deploy contracts on those chains. But it also means that the borrowers don't have to launch multiple pools and manage multiple pools. So if you can imagine from a borrower's perspective, if you have a borrower pool on Ethereum, on Polygon, on Avalanche, on Binance Smart Chain, on Arbitrum, and so on, it becomes very inefficient to sort of be managing, the liquidity, the utilization of all of those pools. So it's not ideal to have Clearpool existing on all of those chains. And if we did, we'd see that the borrowers would probably just select, one or two at the most of those chains. But with the Layer 0 integration, it will mean that just one instance or two instances of the pools can be live, and at the same time can still attract liquidity from all of those different chains. So I think that's a bit of a game changer, and it's still in development, and it will be some time before we launch that. But once it's live, I think this is going to be very, very beneficial to the protocol.
Thank you. That's really exciting. Now we know that you guys came out, or the token came out at a pretty difficult time because it was during the end of the bull market. Now that we're in a pretty brutal bear market, how has this affected demand from institutional lenders that use C-pool?
Yeah, maybe I can take this one. Yeah, so I think it's an interesting question. There's a couple of different forces at work here. So overall, right? There's definitely, I mean, so we're talking here about demand for lending, I would say, right? So overall, there's definitely less demand in the first place, right? As the markets became a little bit more quiet, there's less demand on the borrowing side a little bit, and at the same time, there is less appetite of lenders as well, right? Everyone is super risk off, and everyone is really careful after what happened with Anchor, after what happened with Celsius, and after what happened with Three Arrows Capital. So we saw, we went from 120 million TVL, we went relatively quickly down to below 30 million. So it scaled down quite quickly, as there was this risk off environment kicked in. However, then at the same time we saw another main force happening, and the other major force is that basically you see that on the centralized lending side, a lot of the players are in trouble. Obviously we all know what happened with Celsius and Babo and a couple of other guys, but basically all of those people massively cut their loans, so they wouldn't be lending anymore to those players, and frankly speaking, a lot of them are in trouble. So what that means for DeFi is that at the beginning, it seemed that the market went very bad. There was less demand, but at the same time, it seems that DeFi is benefiting from all of that because CeFi guys, or when I say CeFi, I mean centralized finance, the likes of Celsius and BlockFi. So these guys have obviously made that there were some problems with their practices, as Rob mentioned. And as a result, all of the borrowers, and previously, the majority was centralized. The majority is still centralized. But previously, DeFi only represented a very small portion. And then suddenly, DeFi became a lot more important because a lot of those centralized guys couldn't really cater to this market anymore. And also, everyone basically realized that there is a lot of issues with those centralized guys. You don't really know what's happening. You don't really know who they give out loans to. You don't really know what other things they're doing with those funds. So I think what we're seeing right now is we first of all see that there's again more appetite for lenders. They still want to earn yield. They're just more demanding, so they are requiring more information. They want to have better assessments being done. So we are providing more information. We don't just give the letters, but we are also connecting our lenders sometimes with the borrowers. We are giving more granular information. And then at the same time, we also see that there is a big push now from CeFi to DeFi. And the main thing is just that DeFi offers a lot more transparency. So obviously there is still risk of borrowers defaulting on DeFi. But if someone defaults on DeFi, everyone will immediately see that this counterparty has defaulted. While on CeFi, a lot of things happened and there was no transparency. You couldn't really see anything. And then, a small hole that possibly could represent a small loss might become a very, very large loss that becomes, too large. And then everyone is basically losing a lot of money. It results in a catastrophe, as we saw. So overall, I see that everything that happened is actually quite bullish for DeFi lending. And maybe one more thing is we see that, previously borrowers, they could get away with, just providing very little information. Sometimes we all know that 3AC, borrowed funds without you really providing financial statements. And now what we see is that lenders are, as I mentioned, a lot more demanding. And I think we mentioned before that we have this platform where a lender can withdraw at any point in time. We consciously did that. We think it's very favorable for lenders versus other platforms where they need to wait for 3 months before they can withdraw any funds or longer. And again, we see that this no lockup period is a strong demand driver for Clearpool. So while we went down to below 30 million, when the whole 3AC thing happened. I think right now we are just about to cross 110 million again, and we're growing quite fast. So overall, we actually see that the momentum is there, and we see that there's going to we believe there's going to be a big transfer from people lending on centralized players with centralized players to decentralized players like us.
Yeah, I would just add to that. Basically, once we got through like the height of the volatility, what we've seen is an increase. I mean, you can see an increase in the liquidity on the protocol. It started to increase in mid-July. So this was around the time, I guess, the height of the volatility was reached. It seemed like the contagion effects were out in the open. And what's happened since then is that the TVL of Clearpool and other DeFi protocols started to increase again. And I think that's key. What Jacob mentioned is that, and also what I touched on earlier about lenders, depositors on the centralized players, are now starting to look at DeFi, as an alternative, as a safer alternative, as an alternative that gives them more control, more transparency. So now that the volatility is over, we've got a little bit more transparency on what happened on the general effects. I just think that dynamic is going to continue, and we'll see more and more of those participants that were previously depositing, lending on the centralized players, starting to become more confident to do so in DeFi.
So now that we are in a pretty gnarly bear market, do you guys have anything in place for this current bear market if it were to last a little bit longer than expected?
Well, we have sufficient resources to last out even the longest of bear markets that's ever existed previously. So we've got the resources to weather even the most worst bear markets. We also have a team which is very committed for the long term, and that team is just fully focused on building. So for us, it doesn't really matter if it's a bear market or a bull market. We have a roadmap. We have a number of products that are in the pipeline. We have a number of things that we're working on to enhance the growth and scale the protocol further. So we just continue to work on all of that stuff. And yeah, because of the resources that we have and the team that we have, of course, we all look at the markets, we all hear the noise, but actually in a way we just try to turn off from all of that noise and just continue to do what we do. I think Clearpool is one of the projects that has continued to deliver on its roadmap, throughout this bear market. I mean, we kind of launched in the bear market in a way. It was in March, and the downturn had already began. Of course, it was after that, that we had the catalyst for what happened next, which was USDC. But in a way, since we launched, it's been bear market. So, we've not really known anything different. But yeah, we just continue to work on the plan that we had, and there's plenty more to come. We're working on a number of new products, product enhancements, marketing initiatives, and other strategies that will enhance the protocol itself and scale the protocol. So yeah, we just continue to work on that.
My mic just went off. So what are some, now that you kind of mentioned a little bit of the plans that you guys are building on, what are some future plans for Clearpool? What do you guys have planned?
Well, I guess the next biggest thing that will come, which is not too far away, is going to be the delegated staking model that we've been working on for some time. This is super exciting. It's quite a big product in itself. So essentially, this will mean that anyone with cpool, will be able to stake cpool on the protocol. They won't have to do that on exchanges anymore. The best yield for doing that will be available on the protocol. But by doing that, by staking on the protocol, you'll also be participating in securing the interest rate model, interest rate mechanism, which I described earlier. So this is moving to an Oracle system. So right now, the inputs.
Sorry, I think the connection is bad, right?
Okay. Can you hear me?
We can hear you.
Okay. So right now the inputs that shape the interest rate curve have been provided by a number of participants, basically stakeholders within Clearpool and who are very close to Clearpool, some projects and advisors and partners. So these inputs will, once the staking is launched, will be provided by what we're calling Clearpool oracles. So all of those original stakeholders will also be oracles. There'll be a number of others as well. And those oracles will vote on the rates that they believe should form the shape of the curve during each epoch. And at the end of the epoch, we'll take the median, basically, of those inputs and use that to shape the curve, to price the curve for the following epoch. And then any of those oracles that have been successful during that epoch will be rewarded with cpool emissions. So as a staker, you will basically also be delegating your voting power to one of those oracles. So when you stake on the protocol, you'll be asked to delegate the voting power to an oracle, so you can select an oracle. And if that oracle is been successful, you will share in those rewards. And basically, the oracle will be taking a commission, a fee for doing the work. So it's been quite a long time in development, and we're still testing it right now. Both the product and the methodology that is required of the oracles. But we're getting quite close, and this is probably going to be one of the next major announcements that we'll make in terms of product. Beyond that, we've got a number of sort of smaller product enhancements that will make the user experience, improve the user experience for both borrowers and lenders. And we have other things like thematic pools on the way, which is thematic pools are basically, it's a single pool. So you can provide liquidity to a single pool, and that pool will distribute that liquidity across a number of other borrower pools algorithmically. And so the pool will have a mandate. Let's say that mandate might be just to distribute the liquidity evenly across all of the pools, or maybe the mandate is to spread the liquidity evenly only to the highest rated, AA rated borrowers. Obviously, there could be various different mandates, but those pools will allow lenders to diversify their liquidity across a number of borrower pools in a single transaction. So they won't have to do that themselves, and the pools will automatically rebalance and compound the interest. So that's also exciting product which is coming probably later this year. And a number of other stuff we already talked about. We're doing Layer 0. We've had a recent announcement with Idle Finance, also integrating with Clearpool's off tranching. So there's more stuff coming there. And yeah, lots of other stuff that we're working on. Basically, you can see most of it in the roadmap. There's some stuff that isn't in there because it's kind of still in the idea phase. We'll add it, as it becomes more concrete. But yeah, there's a ton of stuff, which is going to keep us going for a very long time. So yeah, exciting times.
Exciting stuff. For those who haven't looked at the roadmap, I posted it into the AMA VC. Go have a look at it. It's some pretty exciting stuff that's coming out. That brings me to my next question. We have seen a great partnership being formed with Reimagined Finance. Can you tell us a little bit more about that?
Yeah, so the refi guys reached out to us. They got introduced to Clearpool. I'm not sure where from, but they loved what we were doing. They reached out. We had a conversation, did a podcast with Huff quite recently. And yeah, during all of that, they started lending on the protocol. So Reimagined Finance is LPing in some of the pools, and we just see how it goes from there. They have some great ideas. Obviously, they have exposure to a lot of other projects through what they do. And I think they have a really interesting model themselves. So we'll continue to keep the conversation going with them and see if there's other things we can do together, to attract more liquidity from their community. But so far, it's a great partnership. It's not really a partnership. We haven't announced any sort of partnership. But they've basically been participating as a lender on Clearpool for some time now.
So, I think Jacob is having connection issues. Let's see.
No worries, I can continue.
Okay. So how do you view the current market state from a builder's perspective? And do you guys have advice for people that want to build a platform in a market like this, like the one we're on?
So as I said earlier, I think from our perspective, we had a plan, we had a roadmap, and we we're going to stick to it, whatever. That's how we look at it. But I think that a lot of very good projects are born and built in bear markets. So I think it's probably as good a time as any. So if you were going to launch a project, it takes some time to build. Building it during a bear market is not a bad idea. Given that you may get to launch it when the market is turning. But it's very difficult to time the market. So I wouldn't advise that anybody try to do that. But if I certainly wouldn't delay, the starting or starting to build a project just because we're in a bear market. In fact, it could be a good time to do that. The one thing I would say, the one bit of advice I would say is what I said earlier is to kind of just switch off from the noise. If you have a good idea, if you are confident in the idea that you have, you don't really need to listen to anybody else. You can just sort of switch off from all of the noise and just go ahead and get your head down and build it. That would be the one bit of advice. If it is advice, if it helps in any way, I'm not sure. But that's, as I said, that's what we do. We have a plan. It's a very long-term vision that we have. So I'm sure this won't be the first bear market that we'll see. It won't be the last. So we just carry on and yeah, we have a very long-term vision. So nothing's really gonna get in our way of realizing that vision.
I love that. Yeah, as you said, a lot of noise, especially during the bear market. Why is this coin going down? It's a shit coin automatically. Like, ridiculous.
Absolutely. Yeah.
So, what are some challenges for Clearpool at the moment?
Well, I think I guess one of the things Jacob mentioned earlier is that some liquidity left the protocol during the volatility. But in all honesty, this is kind of this is expected. So Clearpool, going back to what I said at the beginning, it's a very dynamic protocol. So because we decided to make it that way, so that the initial thing we were trying to solve was the problem of over collateralization for borrowers. Right? This is the problem that we identified that existed, and that was the problem that we initially set out to solve. But actually, we wanted to create a protocol that was going to give lenders the opportunity to manage risks, because the only way to really solve the problem of over collateralization is to reduce it, and that means that you're introducing counterparty risk and credit risk. So we wanted to create something that gave the lenders the opportunity to monitor risk, to manage risk, and to hedge risk. So those were some of the things that we were thinking about initially, and not just to solve that problem for borrowers, but to solve it for to give lenders something interesting as well. So that's why we built Clearpool as we did, and it's actually because of that we'll see fluctuations in liquidity provided through different market cycles. But the key point here is that the protocol is designed to withstand that, and we've been given the mother of all tests through all of this, having launched in March and then immediately gone into the whole Terra USD UST and then the rest of it, the 3 hours and so on. The protocol performed exactly as it was designed to do, and it's now coming out of that, and we're starting to get a lot more interest and a lot more growth. But yeah, I guess in terms of challenges, one of the things we want to do is really to try to attract more liquidity, because when you have withdrawals, when there are fewer LPs in the pools, it makes the utilization spike much higher, because you have fewer LPs, and let's say one of the larger ones decides to remove the liquidity, it can send the pool into much higher utilization, and that forces then the borrower to repay. It can in some cases also attract new liquidity because the interest rate is much higher. We have seen that dynamic play out, but ultimately as we attract more lenders to the protocol, it's going to smooth out that process. So ideally, we want to have thousands of lenders in these pools, not hundreds, which we have at the moment. So I think one of the challenges is really just in this bear market is to just continue to get the word out there, to educate people on what Clearpool is, how it works, and how it improves incumbent systems in this space. So I guess that's one of the challenges in a bear market. In general, I think challenges for Clearpool have been, I think one of the biggest ones was managing the fact that when we launched our token, and again, this goes back to what I said earlier about not being able to time the market. When we launched, we had no idea that shortly after that, it was going to be one of the biggest bull markets we'd ever seen, and Bitcoin was approaching 70,000, and before we'd even launched anything, we saw the price of our token go sort of astronomically high during that bull market. But then by the time we actually launched our protocol, we're in a bear market, the price is much lower, and it's very hard to deal with the effects of that, because right now we have a working protocol. We have $105 million of TVL. We have huge institutions using it like Jane Street, Block Tower, Wintermute, Amber, and so on. We've proven, we've proven and delivered on everything that we said we would, and yet the price obviously is much lower than what it was before we even delivered anything. So just managing that is very difficult. But I think it's probably the same for a lot of other protocols. So I don't think we're alone there.
Yeah, for sure. I mean, we've been kind of monitoring Cpool for before Clearpool even came out. We've been kind of just waiting, and then yeah, the timing was a little bit off in terms of what the market did thereafter, and I guess that brings a lot of FUD with people that look at the price and they don't see the big picture of builders. They're actually building and making things happen during the bear market, which is impressive by itself. Um, I think once the bull market comes back on, everybody will just forget all about the FUD and whatnot. So are you open to having any community questions, Robert?
Yeah, I've got 10 minutes if that's okay.
Yeah. So if you guys have any questions, go ahead and put them into the AMA VC area. It's right above the Discord stage. I think Don had a question. I don't know if he's in here at the moment. So Don had asked, can you ask them about the future of permissionless pools if there is time? When will additional LPs be able to lend? That was his question.
So permissionless pools, we have a number of new borrowers in the pipeline. So there are various different stages, but there's definitely some that are going to be launched soon. So one of the things that we've been doing, during this volatile period is to be quite careful on the borrowers that we've been launching. So they all have to go through a process, KYC, KYB, whitelisting, verification process. They're all required to get that credit rating from Credora. Earlier on, Jacob referred to them as X-Margin. They actually just rebranded to Credora. It's the same project. So yeah, once they've gone through that process, then they have to stake Cpool, then they can launch a pool. So we've got a number of borrowers that are at various stages of that process, but we kind of decided to slow it down a little bit until we had that that visibility, that transparency on on how far the contagion spread from recent events. So now the dust has settled on that, I think we can start to maybe think about accelerating the launch of new pools. So there's a number of borrowers coming online soon, and from a lender's perspective, anybody can connect and lend. So it's completely permissionless. That's why they're called permissionless. Anybody can connect with their wallet and lend as little or as much as they want. So I think when we launch more pools, yeah, I guess we'll also see see a growth in the liquidity on the platform, on the back of that. So that's something that will happen and will continue to happen. But there's quite a big pipeline actually of new borrowers. So we'll have a steady stream on the permissionless side. I'm not sure if the question was on permissioned or permissionless, but anyway, so we also have the one permission pool at the moment as the one with Jane Street and Block Tower. We've also got a lot of interest here as well. So Jane Street is a more traditional financial institution, and those type of borrowers, they basically have compliance and risk departments, and a lot of them are regulated. And what this means is that they need to have visibility on who the lenders are. They need to know that those lenders have been KYC'd, etc. So they, even though they they love the concept of the permissionless pools, they cannot participate right now. So the permission pools are designed for that type of institution. So that was the first one. Again, we've got a lot of interest here. But what we're doing there is we're actually building a more sophisticated product specifically for permissioned participants. So we're actually building up an ecosystem of these guys, similar profiles to the guys that are in that pool. And once we have that product built, they will basically have all gone through the same KYC, KYB onboarding process, and then they will be able to effectively deal with each other, in a decentralized way, through Clearpool, but still have that visibility on knowing that who they're dealing with has been through the onboarding process. So yeah, that's something else that we're working on right now, and that's all I can say on that. But yeah, keep your eyes peeled. That's going to be interesting.
Hope that answered his question. Definitely did. I bet he's excited. So he did ask another question. Are there any special considerations one needs to make if I'd want to onboard with Clearpool as a centralized exchange, primarily LPing/lending, KYC, smart contracts, insurance, etc.?
So if you want to lend into the permissionless pools, there are no considerations. All you need to do is connect with your wallet, MetaMask or Wallet Connect, and you can start lending immediately. Of course, you'll want to do some due diligence and some research on the borrowers that you're going to lend to, and you can use the tools available on Clearpool, like the Credora rating. You can go and do your own research on those borrowers. Once you've made that decision, it's simply a case of connecting with your wallet, inputting the amount of liquidity you want to lend, and clicking provide, and then that's it. It's the exact same process that you would have if you were using Aave or something like that. It's very, very simple. But if you want to be a lender to in the permissioned environment, then you will have to go through a KYC, KYB onboarding process. So you can just reach out to us at bd@clearpool.finance. That email will come through to the business development team, which includes me and Jacob as well. And yeah, we'll get back to you with the next steps for that process.
Great stuff. We did have a question from Conrad here. What does the Clearpool marketing department look like, and who heads it?
It looks beautiful. You can go and have a look at Sam's picture online. So Sam Amin is our CMO. Sam has been involved in Clearpool since day one. He was on the very first call that we had when Alessio and I decided to do this. Sam at the time was working at Hex Trust. So Alessio is the CEO of Hex Trust, which is a licensed digital asset custodian. Was founded in Hong Kong, but is also licensed in Singapore and now in Dubai as well. So yeah, he was working with Hex at the time. He'd been involved in Clearpool since day one, and ultimately he became the CMO, full-time CMO of Clearpool. Sam has a couple of guys working for him, and yeah, they work very hard right now on sort of mainly sort of like organic marketing strategies. Because we think that spending money on marketing in a bear market is kind of a waste of money, and you can already see the traction that Clearpool is gaining without actually spending a lot of money on marketing, and that's really down to the hard work of Sam and his team, and and what they're doing, and of course the fact that we do have a very interesting product, and now people are starting to take notice of that. So yeah, that is the marketing team, and Sam is quite active in our Telegram. So if you've got any questions for him, you can stick them in there. I'm sure he'll pick it up at some time.
Awesome. Are there any other questions? Oh, someone PM'd me. Are you guys hiring right now? That was the question I got.
Well, we're always looking for talent. So we don't have any sort of areas where I think we are sort of understaffed, if you like. We're actually quite a lean team. In total, with the developers, there's about 12 of us full time, and a couple of part-time guys, and we have some advisors that are pretty active with us as well. But yeah, I mean, that covers, that kind of more than covers what we need for the time being. But I would say, probably more on the developer side, if anything, because the more developers we have, the faster we can deliver, on the roadmap. But we have a really close-knit team. That everybody works very well together. Everyone knows what they're doing, and having said that, because we're quite a small team, we all have various roles and things that we take care of. But if anyone's interested, again, there is a section in our Git book where you can send us your details.
I'll post that right on the VC chat. There you go. So go ahead and email. Okay, so we did have 2 last questions, but we are running out of time. Yeah, maybe we'll do that some other time, some other AMA we can go to. But I appreciate you for coming along and having this AMA with us. A lot of us are holders of Cpool. We've been a big fan since before everybody knew what Clearpool was. But we thank you for jumping along and answering these questions.
It's my pleasure. Thanks for inviting us. It's great to be here. And I didn't hear Reda's voice today, which is a shame. I like to hear from Reda. Is he there?
Reda.
Oh, hey Rob, what's up, man? No, I let
How you
Athena do the interview. I hope you're doing good. No, it was a nice interview. Like most of the questions, me and Athena worked on them together, and
Awesome.
really interesting that you guys are taking the multi-chain route. So linking up with different chains. So that's really interesting to see, especially with Layer 0, which is a very interesting protocol as well. So yeah, I'm excited for the future, Rob. And like you said, you should ignore the noise. I was here in 2019 when Matic started, and everybody was saying to them too, "Oh, it's not good. The protocol's bad, the chain is bad." But they silence everyone by just building. So just keep going, man. And
Yeah, absolutely, completely agree. Yeah, as
yeah,
I
like
said,
Zilliqa, like Matic. I
Avalanche.
mean, I've seen that. I've seen the previous bear market, and
Every project goes through it. We've
Yeah.
thankfully, we've been through it now. I think we have really good sentiment in the community now. New joiners are coming in. They're asking questions about the product, which is that's what we want. We want that type of conversation. Yeah, that's where we're at now. And I think I think the growth that we're seeing now is very positive, because I've no doubt that that's just going to accelerate as we start to come out of this market.
Yeah, I would just focus on I think I said this months ago, like the Telegram thing.